Good morning, everybody, and welcome to our webinar, Family Investment Companies with Matt. We will be taking questions through the Q&A box and we will be answering them at the end. Thanks, Matt. Over to you.
Thanks very much, Sarah, and good morning to everybody who's taken the time to join us this morning on our latest webinar series. For those of you who are regulars with us here at ETC, we do regular webinars and are currently doing one on succession, which we'll mention just at the end. But today's webinar is going to be focusing on family investment companies. This webinar is designed to be a bit of a high-level overview to raise awareness around the types of things you need to kind of be aware of when it comes to family investment companies. And as Sarah mentioned, we'll take some questions within the allotted time that we've got at the end. So without further ado, I will proceed. A little bit about me very quickly. There's obviously me and my picture in black and white. The LinkedIn profile there on the QR code, if you'd like to add me on LinkedIn, that would be great. Be great to link in with any of you guys who are listening in this morning. I'm Associate Director here at ETC Tax, and we are a tax advisory boutique that designed to assist members of the public and also other professional advisors with complex tax requirements. Okay, on to family investment companies then. So, what is a family investment company? Oh, apologies. What will be just a quick introduction. Apologies. What we'll be looking at today is first of all what a family investment company is, how a family investment company might be structured, things that we need to think about when looking to set up a family investment company, family investment companies and inheritance tax, and also what are the benefits and potential drawbacks of setting up a family investment company, and why a family investment company might not be the right thing for you and your clients. So, what is a family investment company? Plain and simply, it's a company. It has the same governance and compliance requirements as any other company. Therefore, it has to submit a company accounts, corporation tax returns, statutory declarations, and all the rest of it to HMRC and Companies House. Family investment company differs from a regular company in the sense that you alter the types of shares that the company has and how they are held, which we'll come on to later in this webinar. The aim of a family investment company is to build family wealth in a tax-efficient way, which the proprietors can benefit from during their lifetime, but then pass on to their children in an inheritance tax-friendly way. And that's the real key to this type of planning, is that the family who set this structure up can also benefit from it, unlike a family trust structure, for example. So how might a family investment company be structured? On the right-hand side, you'll see a very simple diagram of a typical family investment company structure. Most family investment companies are set up by mum and dad, and they will each hold a separate class of share, in this case, A shares and B shares, just to allow them a bit of flexibility on extraction from the company. If, for example, husband or wife is a lower earner than the other. And then additionally, additional class of share, which we'll call the C shares in this case, are either held by children directly or by a trust for the benefit of their children. The A and B shares held by mum and dad in this case will have voting rights, they'll have rights to receive dividend income, and they'll have capped capital rights up to a specified amount. Now, you can alter the rights of shares and cap the value of the shares at a particular amount, but it needs to be more than the current value of the business. So if this is something that's already well established and is already worth, say, £1 million, if you wanted to cap the rights at a smidge over £1 million, then you can do, but you can't cap it at less than the current value of those shares. The additional class of share, the C shares in this case, can have voting rights. It can also have dividend rights, and it will have the capital rights above the amount capped on the A and B shares. So in the short scenario I gave before, anything over the £1 million effectively falls within the C shares. There's a couple of different type of typical family investment company structures, which I've shown on this slide here. Family investment company there at the bottom with A and B shares held by mum and dad. You could either have the C shares held by a trust for the benefit of children or a specified pool of beneficiaries. Or alternatively, you can have mum and dad holding A and B shares, and then a separate class of share held by each individual child that you wish to benefit from the structure. In each case, the C shares, D shares, E shares, and F shares in this scenario are the ones that will have the growth, and the A and B shares are the ones which have the capped capital rights, as previously mentioned. You'll see just at the top there that mum and dad are in most cases on the trust structure, the trustees of the trust. So even in the case where you have voting rights, etc., on the C shares, mum and dad are the trustees of the trust anyway. So there's no loss of control. So with regards to those two options, the C shares can either be held directly by mum and dad's children, which allows dividends to be paid directly to the beneficiaries rather than via a trust structure. These are slightly more risky in cases of divorce or bankruptcy. So in the case where one of the shareholders perhaps finds themselves in a situation where divorce or bankruptcy is an issue, the value of their shares could become within the proceedings for divorce or bankruptcy, which obviously you want to potentially try and avoid. And also, multiple classes of shares would need to be issued in order to afford each child flexibility of any dividends you wish to pay them. If you were to just issue a class of C shares that's held equally by a number of children, and wanted to pay a dividend to, say, your 18-year-old son or daughter who was going to university, if you have another son or daughter who's perhaps 15 or 16, if you were to declare a dividend on the C shares to try and assist the 18-year-old, the 15 or 16-year-old would also be entitled to that dividend, which would either have to be waived, or indeed that dividend would be taxable on mum and dad. So issuing additional classes of shares just adds a little bit of flexibility, but then just adds a bit more complexity to the structure of the family investment company. The shares being held by a discretionary trust for the benefit of mum and dad's children, however, does allow income to be paid to the beneficiaries via a trust, and we'll go into detail as to how that works later on. It protects against the divorce bankruptcy scenario mentioned before. It is unfortunately an administrative burden. HMRC's compliance of a trust is unfortunately burdensome, and again we'll pick that up ever so slightly later. But it enables a pool of beneficiaries to benefit from a single class of share. So you can dividend cash to the trust and then distribute from the trust to whichever beneficiary you choose. So it adds, again, a little bit of ease and flexibility by having the trust structure in place. A family investment company can be funded either by share capital subscription, so putting the money in exchange for shares, alternatively by way of loans. From our experience, loans are infinitely more popular because wrapping your value up in share subscription, share capital subscription, means that in order to get your money back, you essentially have to sell your shares. Loans, however, once the money is put in, you can repay those loans at your leisure from future company profits. In most cases, as I say, mum and dad usually loan the money into the company or dispose of a personally held asset into the company in exchange for a director's loan account credit. With regards to the C shares, any issues? The initial value of the C shares will usually be low or par value, as particularly if you're setting this up from scratch, the company is essentially worthless. Even in the scenario where you've put a £500,000 of cash into the company, to balance that out, it'll have a £500,000 liability owed to the shareholders, meaning the balance sheet has effectively a nil value. So the creation of an additional share capital, a share class, sorry, will result in not much value being transferred. HMRC may seek to argue that the C shares have some value, being that they can benefit from dividend income and growth. But it's a tough argument on HMRC's side, as at the time the transaction takes place, there are no assets and there's no guarantee of any growth. So HMRC may look to impose capital gains charge on a transfer of value on the issuing of the C shares, but I think it's quite a high bar for them to reach. So things to think about then. If you're looking to transfer a pre-owned asset into a family investment company, maybe a portfolio of stocks and shares or a property, often clients already have investment assets that they want to put into a family investment company in order to reduce their personal tax burden from income tax. So if they're receiving dividends or interest from an investment portfolio or perhaps rental profits and are paying 40 to 45% income tax on that income, by moving those assets into a family investment company, you could benefit from a 25% corporation tax rate. However, there are potential issues with transferring assets into a family investment company. Firstly, capital gains. If you transfer an asset from your personal ownership into a company which you control, which means you effectively are the main shareholder of that company, you're deemed to be selling the asset to the company at its market value. So even if the company doesn't give you anything for it, you're deemed to be selling it at its market value. In the example, Mr. Challoner, who's a high rate taxpayer, wishes to transfer a portfolio of 100,000 shares in Apolloid Limited into a newly formed family investment company. The shares are valued at £300,000 and he purchased them for £175,000. The disposal of the shares into the company is a market value transaction, so the deemed proceeds are 300,000. They cost him 175,000, which realizes a gain of 125,000. Deduct the annual exemption on the assumption he hasn't already used it elsewhere, and that gain of 122,000 would be taxable at 20%, resulting in 24,400 of capital gains tax payable. In addition to capital gains, if you transfer land and property into a company, the company is required to pay stamp duty land tax on the value of the land and property being transferred in. Important to note that companies always pay the additional 3% surcharge, so there isn't a portion of stamp duty at 0% like there is for individuals. The starting rate for stamp duty for companies is 3%. So in example 2, Mrs. Horsfall wishes to transfer a buy-to-let property she owns into a newly formed family investment company. The property is valued at 575,000 and was purchased for 338,000. So just as before, capital gains tax, there'll be deemed proceeds of 575,000 being the value of the property. Property cost Mrs. Horsfall 338,000, resulting in a gain of 237,000. Deduction of the annual exemption of 3,000 leaves 234,000 of taxable gain at 24%, because let's not forget that the rate of capital gains tax for residential property is higher than for other assets. So that results in a tax liability of 56,160 on capital gains. Stamp duty land tax will be payable with a property value of 575,000. The first 250,000 will be at 3%, the next 325,000 at 8%, resulting in a total stamp duty land tax liability of £33,500. Total, therefore, of capital gains and stamp duty together, £89,660, which on the face of it seems quite painful, particularly given that the individual hasn't received any funds in order to pay that tax. They've simply transferred that property into the company. However, in exchange for transferring the money into the company, Mrs. Horsfall would have a director's loan account, a credit owed to her by the company of £575,000. The CGT and SDLT liability is substantial, but as I mentioned, Mrs. Horsfall, I should say, would receive the IOU, which she can draw down on over time. The effective tax rate is just 15.5%. So if you're thinking of what, comparing that to income tax rates, if you use that 575,000 to replace your income tax position, well, then you effectively replaced it with a rate of 15.5% instead of 40 or 45%. However, in order to do that, you will have had to outlay the 89,000-ish upfront. So short-term pain for long-term gain. It's certainly something that clients are considering when we're looking at family investment companies. And some do opt to pay the capital gains stamp duty in order to get that IOU. In addition to a pretty good effective tax rate of 15.5%, let's not forget that the long-term goal of a family investment company is inheritance tax savings, which we'll move on to shortly. Just want to cover very quickly the administrative burden with a family investment company. It is, like as mentioned before, it is a company, so it does require the usual company accounts and corporation tax returns and so on. The addition of a discretionary trust for the growth shares requires an annual trust tax return to be completed if incomes received or distributions are made. There may be exit charges or 10-year anniversary charges on the value of the assets in the trust, which is important. So every 10 years, the trust assets are valued and a charge of 6% is applied to the value of the assets in the trust. Another, I guess, cost that needs to be factored in when considering the structure. And also a trust must obviously keep its details present and correct on the trust registration service. So the trust tax merry-go-round, this is with regards to sending cash or funds from the family investment company to the beneficiaries via a trust structure. It is probably the most burdensome part of trust administration when it comes to making payments. When a discretionary trust receives income, it pays tax on that income at the trust rate of tax, which is equivalent to the additional rate of income tax. So that's 39.35% on dividends and 45% on other income. When the income is distributed to the beneficiaries, however, it's done so net of the tax paid by the trust. So effectively, the individual receives the net amount after the tax has been paid. The beneficiary will therefore need to reclaim back the tax from HMRC for any overpayment. So if the trust is paying tax at, say, 45%, and the individual is a non-taxpayer, they'll be able to reclaim it all. And if they're a 20% taxpayer, they would reclaim 25% and so on. So just to give you a bit of an example, mum and dad wish to send £10,000 to their daughter who's 18 to assist her with paying university tuition fees. The family investment company therefore pays a £10,000 dividend to the trust. The trust pays 45% tax on the dividend distribution, so £4,500 HMRC. Technically, the trust immediately would pay less. This is again where it gets slightly complicated. The trust would pay 8.75% on the first £1,000 and 39.35% on the rest. However, when it distributes the funds to the beneficiary, it has to top up the difference up to 45% because the tax credit to the beneficiary can only ever be 45%. So to make things easy, I've simply suggested that the tax is 45% upfront. The trust, therefore, having paid the £4,500 over to HMRC, pays the remaining £5,500 to their daughter. And their daughter, who is a non-taxpayer, reclaims the £4,500 from HMRC, which results in a neutral tax position. The daughter has ended up with £10,000 in her pocket, but just in a very roundabout way. As touched on before, if the daughter is a basic rate taxpayer, she would only be able to reclaim 25% or £2,500 of the tax overpaid. If she was a high rate taxpayer, she could claim just 5% or £500. And if she was an additional rate taxpayer, there's nothing further to claim. Family investment companies and inheritance tax then. So while family investment companies are largely used to manage individuals' tax exposure during their lifetime, arguably the main benefit of using a family investment company is the potential inheritance tax saving it can deliver on death. By creating the growth share structure, i.e. the C shares as mentioned before, the majority of the company value would not fall within the individual's estate for IHT. Instead, only the capped value of the individual shares is within the estate. In this example, Mr. Hinchliffe creates a family investment company and loans £250,000 into the company. He caps his share value at £10,000. Over the course of his lifetime, Mr. Hinchliffe draws down on his loans from the company to supplement his income and enjoy his retirement. At the time he passes away, the company has grown and has a value of £1.5 million. As the loans have been fully repaid, it's only the £10,000 capped value of his shares that fall within his estate, with the remaining 1.49 million of value falling on the C shares, therefore outside of his estate, resulting in a potential IHT saving of 1.49 million at 40%, £596,000. Of course, Mr. Hinchliffe might not wish to draw down on the loans if his other income is sufficient for him to maintain his standard of living, in which case he could choose to gift elements of the loans to his beneficiaries for them to draw down on over time. The assignment of the loan is treated like a gift of cash, so will be a potentially exempt transfer, providing Mr. Hinchliffe survives 7 years from the date he gifts the loans to the individual. Then the full value of those gifted loans will be outside of his estate. It's essentially a good way of gifting cash without actually gifting cash. So what are the benefits and potential drawbacks of using a family investment company? Benefits? Well, it offers a simpler and more familiar structure than a family trust, whilst offering the same asset protection benefits. It keeps investment activity wrapped in one corporate investment vehicle, which a lot of people like to keep things in one place. The family investment company pays corporation tax on its income and gains at 25% instead of potentially 40 or 45% on income. It allows family wealth to be created in an inheritance tax-friendly environment, as touched upon in the example with Mr. Hinchliffe before. It gives control and flexibility to the owners on which assets they wish to invest in and whether they wish to draw income by way of dividends or salary or whatever, and loans from the company or not. It's entirely their choice. And children can benefit from the structure once they reach 18 by being issued income from the company via dividends if they hold the shares directly or from the trust as discussed. For children who are under the age of 18, they cannot benefit directly from the structure until they reach the age of 18, as due to the settlements legislation, any income that you divert towards children under 18 is effectively re-diverted onto yourself. Drawbacks: touched upon the possible capital gains tax on transfer in of any assets to the family investment company. If obviously the assets that you have are not particularly pregnant with gains, then that's one issue that can be avoided. Stamp duty, obviously, on the transfer of land and property into the family investment company as well, we need to consider, as touched on before. It's important to note that the money in the company doesn't belong to mum and dad. So once it's in there, if they want it back, they'll either need to extract it by way of loan repayment or dividends. The administrative burden, which we touched upon again earlier, of running a company and a trust. And also, if the company is sold, which admittedly these types of structures are designed for future and not really designed to be sold, the majority of any value from any sale would belong to the C shares, not to mum and dad, so they wouldn't benefit from the sale of the business. So why might a family investment company not be right for you or your clients? Well, sort of touched upon with the drawbacks there. If you need all the income from your investments to maintain your lifestyle, then the combination of corporation tax you would pay on the income from the investments and then the income tax you would pay from drawing income from the company would effectively mean that there's no real tax saving. Although, of course, the future inheritance tax saving would still be applicable. So you've got the sort of way up between whether you want to have the administrative burden and all the fun that comes with running a family investment company without making a tax saving during your lifetime, just to sort of maintain the benefit of the IHT saving. But the most beneficial way structure of family investment company is, as mentioned, to leave funds in the company to allow them to reinvest and grow that company outside of inheritance tax. And as again touched upon, if you're planning on selling the assets and using the cash personally, if obviously you own those assets personally and you sell them, you'll pay capital gains tax, but then the resulting funds belong to you and you can do with them as you please. The assets obviously within a family investment company belong to the company itself. If you sell the assets within the company and want the money for yourself, you'll either have to draw it out by way of loan repayment or by way of dividends, which results in an overall higher tax burden. So family investment companies, I guess, really are designed for people looking to set up investment vehicles that they can enjoy income from during their lifetime and then pass that on to their beneficiaries in a very inheritance tax friendly way. Very quickly, HMRC's views on family investment companies, because there are an awful lot of upsides to these, an awful lot of tax savings available. Family investment companies jumped in popularity from around 2016 onwards due to changes in trust legislation. HMRC set up a specific task force to look into family investment companies in around April 2019 to see if they were being used for tax avoidance purposes. That unit was disbanded in August 2021, having found no evidence of tax avoidance or non-compliance, and accepted that there are often commercial reasons for establishing a family investment company. And that's it. That's a quick overview of family investment companies. I hope that there's been a lot of information there that's been easy to digest. If anybody has any questions, Sarah, I'll fling it back over to you.
Yes, Matt, thank you very much. Questions are coming thick and fast. So the first question I've got here is, will HMRC accept Alphabet shares where dividends are being waived?
Usually you wouldn't necessarily need to waive dividends if you've got an Alphabet share structure. You would only usually need to waive dividends if you have multiple owners of a single class of share. If you're setting up a family investment company with Alphabet shares and you wanted to simply benefit one shareholder, not the other, then you would simply declare a dividend on the A shares and not the B shares.
Okay, and the next question is, how do you work out the 15.5% effective rate?
So the tax rate of 80, I can't quite recall the figure, but 80 something thousand divided by the total value of the IOU owed to the individual by the company.
Okay, perfect. The next question, if you were to issue additional shares in the company for the gain, would you be able to claim rollover relief, reduce the IOU loan?
From my recollection, I think the rollover relief is only available for trading companies, whereas this is an investment company. I therefore don't think you can get rollover relief on investment companies. So no.
Okay, the next question, could you briefly outline what would be the considerations if wanting to convert a standard investment property limited company into a FIC? Let's assume the value of the property are 500,000 and no debt.
So they've already have an established company.
Yeah, it says, can you briefly outline what would be the considerations if wanting to convert a standard investment property limited company into a FIC?
Okay.
Assuming the value of the properties are 500,000 with no debt.
Yeah, so as kind of touched upon before with regards to people who sort of have established positions, if you've already got a limited company with assets within it, you can still turn that company into a family investment company by the altering the share classes and issuing the growth share. Effectively, what you're doing at that point is capping the value of the company as it is at that point, and then issuing the C shares to only benefit from the growth above its current value. So there isn't that, and this is, I guess, where the potential for HMRC query would be around whether there's a transfer of value by issuing the C shares. Naturally, the value that's in the company at the moment is held within the A and B shares. It's only future value that's on the C shares. So that's something that, if HMRC were to inquire, would need to be, I guess, defended robustly. But I don't foresee there being much of an issue with regards to a transfer of value when issuing the C shares in the first place.
Okay, the next question. I am assuming the inheritance tax benefit only arises where 100% BPR is not available on the shares, as the company does not qualify for BPR.
Correct. Yeah. So you wouldn't need to do this if it was a trading company, because trading companies qualify for BPR. This is purely for investment vehicles, which would not qualify for BPR.
Okay, and then can you have foreign shareholders in, i.e. non-UK resident?
You can. The overseas element, admittedly, is not an area of my personal expertise, so you'll have to forgive me. I think there are potential issues with having overseas shareholders with regards to sort of governance and that kind of thing. But with regards to if they're a non-UK resident, non-domicile, you wouldn't necessarily need the family investment company structure. Well, I suppose technically you would, because the UK assets would still fall within UKHT. It's probably something we'd need to give a little bit more thought to and provide a better response to on that one, I'm afraid.
Okay. Can a FIC obtain a mortgage?
Yes, it can. Yeah, so companies can obtain mortgages. However, the rates of mortgage interest, I believe, are slightly higher for corporates than they are for individuals, which again is something that would need to be taken into consideration when looking at the overall cost of setting up a family investment company. But yes, you can raise finance on property within companies.
Can a grandparent form a FIC and give shares to grandchildren? Would dividends in this case be of the parent, or can underage benefit from the dividends from the grandparents' FICs?
So I suppose in a sense, yes, you could use a family investment company to benefit grandchildren. Usually, you would do so through a sort of a education trust structure. So providing it's not the children directly that are benefiting, if it is grandchildren, then the settlements legislation doesn't extend that far. So you can use a family investment company to benefit grandchildren.
Will a FIC affect associated company rules?
Not sure is the answer. Again, I'll admit my background is less on the corporate governance side of things. So again, we'll look to provide a better response to that question.
Yeah, we've got people's names on some of these, so we can contact you with a more detailed discussion. Another one what would be the cost range for tax advice for a family to discuss setting up a FIC? Again, we can
Yeah, I mean every FIC is different in its design. So whenever we're talking to potential clients around setting up an investment company, the aim really is to understand the needs of the client first and what they're looking to achieve, and then we'll be looking to advise on their certain circumstances specifically. It's very difficult to put a cost to it without understanding what the client's needs are first.
Okay. I've got time for a couple more. They keep coming in, these questions. It's obviously a hot topic. Is there any way to get around the marriage risk of issues share class directly to children, like prenup, and would this hold up in court?
Yeah, it's one that I've been asked before, and obviously it's more of a legal basis. I wouldn't like to comment on whether a prenup would stand up in a case of a divorce settlement if someone was owned shares directly in a family investment company structure. Naturally, if the individual was a beneficiary of a discretionary trust, then it removes that issue entirely. But whether you could achieve the same thing with a prenuptial agreement, I wouldn't be able to comment. I'm not a law professional, I'm afraid.
In the instance of a daughter reclaiming the tax paid, does that need to be done via self-assessment, or is there a simpler way? I may expect a younger person to not do an annual self-assessment.
Yeah, so if the individual does already complete a self-assessment, if they are an adult, for example, and they're required to do one anyway, then yes, you simply reclaim the tax. In fact, indeed, you have to declare the income on a self-assessment return anyway if they are of a certain age. But if not, then you can still reclaim it informally through an R40 form, which is, I guess, similar to a tax return in the sense that it's a bunch of boxes on a bunch of pages, but it's not formalized through the self-assessment route. So you simply fill that in and submit it to HMRC, who should then process the repayment.
Okay. Would an unlimited liability company be useful, assuming holding investments which are not physical property? These seem to be more private disclosures on Companies House.
Yeah, again, that's probably a question that would need some more consideration than one I'd be able to answer immediately.
No problem. And the last one, would it impact the scenario if the investment company were also a holding company that owns one or several trading companies?
Sorry, just say that again. Sorry, I didn't quite catch that.
Would it impact the scenario if the investment company were also a holding company that owns one or several trading companies?
No, not necessarily. So it's actually quite a common structure to have trading companies as subsidiaries of a holding company, and then the holding company being a family investment company structure. Just have to be a little bit mindful when it comes to the overall structure of that, because ultimately the trading companies below would have access to BPR relief for IHT. If the investment side becomes too large and therefore you're no longer holding shares in a mainly trading group, then the fixed structure obviously works in that regard, but it might also just cause IHT to effectively arise, or an issue to arise on the trading companies. In which case it might be worth looking at some point to demerge those two, but not necessarily immediately.
Perfect. And I think that is it. We have got a list of questions. We can print them off as a report and go through them and make sure we have answered any of your questions. Please do get in touch if you have any further questions for Matt. We will be here to help you. If we can just remind you also, we have a couple more webinars coming up. Part 2 of our succession series, Doing the Deal, with Paul on the 4th of July, and we have the other hot topics series, Employee Ownership Trusts, on the 12th of September. Thank you once again. Thanks, Matt.
Thanks, everybody.